Welcome back. We were speaking with Brad Simpson, Chief Wealth Strategist at TD Wealth. We were talking about the environment and that basically the concerns that we had at the end of 22, they're the same now, and it's hard to make a case for the levels of the S&P 500 as to where they are right now.
Yeah.
Having said that, what do you do? That's kind of what it comes down to. So let's talk a bit about, and you have been talking to us about making a case for bonds.
Sure. Okay. And first, for the equity market, when we're saying things like that, like we are underweight equity markets, but we think there's lots of great opportunities out there to be able to invest in. And really, what we're saying is that, but you got to go where the businesses are and where you're going to make money when you're in a late stage. Yeah. And so you have this noise around that, and then the underweight just kind of tells you the story if we're cautious. And so there's different strategies and hedging strategies you can do in that, and we think that being allocated there makes a lot of sense. What surprised me, and then on the fixed income and being allocating there, is, quite frankly, is just the mass movement into term deposits, GICs.
Yeah.
Now, I understand moving in because the yield is high, and we've seen yields in term deposits that we haven't seen in a decade, and so that makes a lot of sense to me. But the challenge investors have is they don't understand how fixed income markets work, and they kind of seem difficult, right? But at the end of the day, you can build an investment portfolio using bonds that have that same sort of yield to it, but with a lot of other attractive benefits that give an investor a lot better opportunities than that.
Like what? Well,
the starting point is that that if I'm going to buy a term deposit, I'm purchasing that because I know when I purchased it, what interest rate I'm going to get, when the maturity is. I can go out and I can buy a traded bond and do the exact same thing. Now, when interest rates go up, value of bonds go down. That's what we saw last year. Bonds, if I want to buy a bond that is trading below its issue value, par, they all mature at $100, right? So when it matures, no matter what, it's going to mature at 100. So if you go out today, there's lots of bonds you can buy below par, like $92, $93, $94 that are going to mature at 100. That move to maturity, that's a capital gain.
Yes.
Right?
Which does not happen in GICs.
Which does not happen in GICs. Yeah. The other side of the coin is that if interest rates go the wrong way, let's say they start going up, and you say, oh, I'm going to lose on my bond. Not so. If you own it directly, it matures at par, and you get your money back. Right? So that has a benefit into itself, the capital gain part and the taxation. And the fact is that liquidity, if you've got to get your money out of a GIC, I mean, you can if you really want to push it, but then you have to bust your way out of it, and then the person who's going to pay for it, you're really going to pay for that. You're going to, right? It's not going to be advantageous to you. That's not how fixed income markets work. It's liquid. You can get in and out of it a lot easier.
It is easy. It is liquid. It's the biggest market in the world. So there's that. But also, they're not quite as easy, I'd say, to trade for the retail investor as equities are.
No.
That's part of the problem. So how does somebody think about it? I mean, one way, they can talk to an advisor, and advisors can manage it for you. Other ways, but what are some other ways?
Well, I mean, that it's difficult. It's just flat out is. It's difficult. It's difficult to gain access to that. And I mean, you can, and there are some direct ways to do it, but it's not as simple as just going out and making a call and saying, I want to buy an equity. Yeah. But nonetheless, I think it's. I mean, we're spending a lot of work on doing this because I mean, when I was starting my career in the early 1990s, I mean, this was a lot of how you built your fixed income portfolio. It was, kind of laddering things up 1 through 5 to 6 years in corporate bonds, trading at a discount. You knew if interest rate went down more, you'd get a capital gain. If you knew they went up, you could hold it to par, and then you could sell it and get it back again. And you could kind of go through this cycle of doing that. It has a lot of that feel here to that today. And so, that we are overweight fixed income, and we're overweight fixed income for a reason. We think that ultimately, look, interest rates are going to likely stay where they are and trades within a range bound here, let's say for the next year. We saw the 10-year U.S. Treasury move 50 basis points yesterday. That's a lifetime move. Yeah. Right? So we're going to continue to see that sort of volatility in bond markets. We're going to continue to see that sort of volatility in equity markets. But the 12 to 18 months out, you're likely going to start seeing a cycle where interest rates have a trend of moving downwards. If you're wrong, you own the bond, it gets maturity, you have your money, out you go.
Yeah.
If you're right, you have a capital gain, you have your interest that you made, you got your capital gains, you got the tax implications with it, and what we like to say, optionality, those different benefits or features of it make that a much more attractive investment than I think and I think you just got to do a little bit more digging and work.
And I guess the risk to this as well too is if rates continue to rise.
Yeah.
If for people who are play poker or things, you could even look at just kind of like the probabilities of this happening. We've got it high, but but rates could still go higher. I mean, that is something that happens.
There's two sides to look at that. So in this laddering that I'm talking about and buying them at a discount, if they do rise, it's not going to impact you.
Right.
Second one is that when you're doing investment, you're right, we're thinking about probable outcomes.
Yes.
And so when we're publishing an article tomorrow, really imaginative title. We got to get, we fired our creative team and we decided to call it Bonds versus GICs. Right? I know it's rivet, Jim, but at the end of the day, we actually walk through their scenarios where if interest rates go down, if interest rates go up, if credit spreads, if credit spreads widen. So what happens when they widen, that the price of the bond goes down because it seemed to be more risk in it.
Right.
We look at all those risks, almost every kind of risk scenario you can think of, and you kind of come to the go, yeah, but it matures at par, and you get and so there's in many ways there's a lot of structural reasons today why this is part of somebody's fixed income portfolio. And I remember when you're coming at it from my perspective, this is all about have an investment portfolio that is driven by a wealth plan, driven by your asset allocation, utilizing a philosophy for making decisions. And for us, this is part of that portfolio approach, which in our philosophy of doing things, which is based on adaptability, it makes a lot of sense in an environment like this.
Well, we're going to have you back to talk about bonds versus GICs specifically in that report, although we got a lot of it here. Thank you, Brad.
Thank you.
Brad Simpson, Chief Wealth Strategist at TD Wealth. Stay with us. Up next, the housing market. Some are predicting to have it hit bottom this summer with a recovery soon after. But will another rate hike by the Bank of Canada put the timing of that recovery in jeopardy? We're going to be talking to senior economist at TD, James Orlando, right after this.